government by an investor. By issuing a bond, a company or government borrows money from investors who in return are paid interest on the money that they have loaned. Companies and governments issues bond frequently to fund new projects or ongoing expenses. Some investors use bonds in hopes of preserving the money they have while also generating additional income. So bonds are often viewed as a less alternative to stocks and are sometimes used to diversify portfolio.
Consider this example. The city of KL wants to build a new baseball stadium. So it decides to issue bonds to raise money. Each bond is a loan for 1,000, which KL City promises to pay back in 10 years. To make this loan more attractive to investors, KL City agrees to pay an annual interest of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for 1,000. Now let's fast forward. Each year, the city of KL pays the investor $50. These regular interest rates continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond, and KL City returns his 1,000 principal investment. This bond was a good deal for both the city and the investor. Now, KL City got the money it needed to build the stadium. The investor received regular interest payments and the return of the original investment because a bond offers regular scheduled payments. First, you need to calculate your total income per month, which may include, say, your salary and the rent from some property you own. By adding them both, you'll be certain of your total monthly income. Second, calculate your monthly expenses by making a list of items you require every month. These may include your groceries, utility bills, your child's school fee, etc. Subtracting your total monthly expense from your monthly income will tell you how much excess money you earn every month, which can also be turned into your personal savings. The term personal savings usually reminds us of our dreams that we can achieve if only we had enough money. It may a new car, a new house, a trip to your favorite holiday spot, and the list goes on and on. Suffice to say, the dreams have no limit. It is said that life's what happens to us when we're busy planning for something else. We can come across emergencies at any point in our lives. Therefore, it's important that we save some amount of money for them. The basic rules of emergency savings are: these savings should be equivalent to 3 months of your total income. Savings should be kept in a current account and an investment scheme separately. 70% of your savings should be invested in a money market fund and 30% in your current account. This distribution of your emergency savings is to ensure that most of this money earns you a healthy profit through the investment scheme until you feel the need to use it, and some of it also remains readily accessible with the help of a current account.
Hi, I'm Shahira.
Hi, I'm Shakir.
Okay, so today we are going to talk about what is the investment plan. So it is true that in order to be rich, you have to become an investor. What are the terms and conditions to start investing? Of course, you need to be 18 years and above. If you are under 18 years, please hold on until you reach 18 years.
Okay, what are the minimum amount to open an account with bank? Well, it can be as low as 10 ringgit, as simple as that.
You can choose to open your bank account with either Maybank, Public Bank, CIMB Bank, or a local stockbroker. It's not about how many accounts you want to open, but it depends on how much the amount of money you want to invest.
Grandfather and grandmother old days, if they would have invested 80,000 in public bank at 1967, if they would have invested 8,800, because back in the days you have to buy 1,000 unit to invest the stock market. So the good news is currently is only 100 unit needed to invest in the stock market. So if you have invested 8,000, guess how much is the value today after 47 years? You are not going to believe this when I tell you the figures is actually now 2.6 million. This is what we gather from the public bank as annual report.
Okay, so how did 8,000 become 2.6 million? Doesn't it breath for you? This is called compounding interest, ladies and gentlemen. Albert Einstein has already said that compounding interest is in the 8 wonders of the world. So whoever knows compounding has wealth in their sight.
So what we are going to show you is to guide to invest stock in bank with very minimal way.
So why we choose bank? Let's say if you want to buy a house, you will have to apply loan. Same goes to if you want to buy a car. Bank is actually a very crucial place where we call it mother of all stocks. Like if you want to buy a car, you need to apply loan. So in order to apply loan, you will go to the bank. So the banking sector to us is the mother of all stocks.
For example, Maybank and Public Bank. These two are famous bank in Malaysia. So do you invest maybe now, let's say 9 ringgit, all you have to do is buy 100 unit. This is only going to cost you 900 million. So what do is you buy this 100 unit, and every time maybe after 2 or 3 months you have extra, then you can continuously buying. So this have a compounding elements. Compounding means a couple thousand unit can translate into million or generating more return and asset reinvesting earning.
Successful investing is all about balancing risk with return. The return part seems easy enough. We all want to see the value of our investments go up. However, investment risk is a bit more complicated than you might think. Let's take a look at what investors mean by risk and how you should consider it when investing your money. According to the dictionary, risk is exposure to the chance of injury or loss, and investors would agree when we invest our money in stocks, real estate, or other assets, we don't want to lose it. So the first and most obvious investment risk is the possibility that we could lose all of our money. And the good news is that if you follow the basic rules of investing that you learn in this video series, the probability of losing all of your money is virtually zero. The bad news is you'll still get nervous when you see the value of your investments move up and down each day. This fluctuation in prices is called volatility. As the price movements get more extreme, the volatility of your investment is said to increase. When the up and down movements get less extreme, volatility is said to decrease. While investment volatility can be scary, it can also lead to significant investment opportunities. Here's how that works. When prices start to fall and volatility is increasing in the downward direction, some investors panic. It feels to them like their money is running down the drain, and that if they don't sell now, they'll end up losing everything. This is the ideal moment to grab investments at prices lower than they're actually worth in. Short volatility gives you the chance to buy investments on sale from terrified investors who are fleeing the market. This is why it's so important to keep your emotions in check when you make investment decisions. Panic can be very costly, so now you know the wise investor's secret: volatility equals opportunity as long as you follow the rules. A self-managed super fund investment strategy is essential. An investment strategy that you regularly review is not just a requirement under super laws, it will help you grow your retirement savings. It's important to consider the age, employment, and retirement needs of your SMSF members. Having a variety of investments helps to spread investment risk. It helps to not have all of your eggs in one basket. Your fund needs ready access to cash, so it can be administrative expenses, income tax, and minimum income stream payments when they are due. So it's probably best to not have all of your fund investments in fixed assets, such as property. Consider the insurance needs of all members. You also need to consider who will be the beneficiary of the insurance. Keep in mind the investment strategy is not something you just set and forget. It needs to be regularly reviewed to ensure it continues to meet the current and future needs of members. There are events during the life of your SMSF that should prompt you to review the investment strategy, including when a new member joins or a member leaves the fund or the fund starts paying an income stream to a member. This may also be a good time to think about whether an SMSS is still right for you. You don't need to make changes every time you review your investment strategy, but you should document the review, and any decisions made to your SMSF auditor can see you've met your obligations. There are penalties for failing to keep records which trustees have to pay out of their own pocket. You can seek professional advice to help with your investment strategy, but remember, as trustee, you are still ultimately responsible for your fund's investment decisions. Being happy often depends on things we achieve during our life's journey. Some of these basic achievements come at certain intervals, as they usually cost a fortune. In order to ensure that you don't have to wait really long to achieve goals like a new car or a new home, categorize these goals as short-term, medium-term, and long-term, and investing accordingly. Calculating and working for an investment plan may seem tiring at this moment, but you're consistent that leopards can ensure that you steer through life without any hassle.